can't seem to get out of this, near-term range that we've been in. What do you think about that, that part of the conversation, this push-pull?
Yeah, there's an oscillation because, earlier in the year, we were looking for the Fed to be done, and then there were concerns that the Fed would only be done if we were entering into a recessionary scenario. And so now we're not seeing evidence of recession. However, we also are seeing the challenges of these long and variable lags and the structural and transitory forces that are keeping inflation, higher than it needs to be.
Sticky, right? I mean, the PPI was a little hotter. Now you could say, well, the core was in line, and that's maybe matters more than anything. But nonetheless, both of these reports this week at least give you pause and say, is inflation coming down fast enough?
Well, it's clearly not coming down fast enough if you think about trying to get to 3% for this year, which I think, there were some pundits that were looking for that this year. You need to be, 0.2% on core month over month to get to the numbers that we're looking for, and we're not there. The other challenge, Scott, and why you're seeing this oscillation is that the equity market in particular is looking for any sign that they can latch onto that they're absolutely 100% sure the Fed is done.
Yeah.
And between the jobs report, it's PPI, CPI, they're not getting that. Now, we could have all of the Fed speakers out there, crafting this narrative that they're crafting, that the bond market's doing the work for us and financial conditions are tight enough. That's not going to be good enough for the equity market to feel comfortable until that CME Fed Watch number goes to a 0% probability for a hike this year.
Jay, it's a good point, right? There's nothing definitive at this point to suggest that it's an all clear. Now, the challenge for all of you is, oftentimes the market has already moved by the time you get the definitive all clear. So it's about anticipating where things are moving. Do you feel like you have enough vision to make a call in the way you want to invest on the way you think things are moving?
So I would say this. I think one of the things that's been evident to me is clearly it's going to be a windy road down. There's no doubt about that, right? So PPI was hotter than anticipated yesterday. CPI was hotter than anticipated today. Core was relatively in line. But we saw some wage deflation last week. Obviously, it was a very strong jobs number. But the thing that I think is really important to digest here is I think we're heading into a new normal. A new interest rate cycle normality, which I think is kind of important to digest. We've been in free money era for a decade and some change. This is a new era. I do think rates are peaking, but the most important point for me is I believe they're stabilizing. And what does that mean going forward? So I'm actually leaning slightly bullish going into the rest of this quarter.
See, I love how you put that because, on the way in this morning, I was thinking about the market and this idea of, after I saw, what the CPI was, it's like, okay, people who are more cautious, Jim, or just downright negative on the market suggest higher for longer is a real potential problem. Then I was like, well, maybe it's just normal. To Jason's word, maybe it's just normal for longer, because the market has proven over time that it's not like 4.5% or 5% interest rates are some incredible barrier for equities to jump over. History's proven that. It's just we're so conditioned to think that, well, rates are supposed to be zero or barely above that because that's what they've been for the better part of the last almost 15 years.
Right.
So maybe normal for longer is the way we need to look at it. But you've portrayed all of this as sort of, I positioned you as Jimmy Goldilocks. But you've potentially have to deal with some bears.
Yeah, and today the porridge is a little cold, Scott. Or hot, however you want, too hot, whatever you want to say. I mean, the CPI is not the piece of news that I was hoping for today. That on the margin, by the way, today's not a good day in the markets, okay? Don't be fooled by what the S&P 500 is doing. That's all tech. Look at small caps. Small caps down 1.4%. Look at the equal weight S&P 500 down about 0.7%. It's not a good day. And the reason, and it shouldn't be. It shouldn't be. That was a bad CPI report. It was the anti-Goldilocks. However, it's only one data point, and there are some other data points. Now, look, the bears, I've said this, Scott, they're not idiots. They're not idiots when they say things like, look at the yield curve and look at higher for longer and look at where interest rates are. The bulls, like me, look at some other data points, okay, that are equally valid, like today's weekly jobless claims, which tells me that the consumer is employed going into the all-important holiday spending season. And Shannon, you're absolutely right. It's going to be pretty hard to get down to 3.0% CPI. It is. Sure. However, if we're at today, 3.7% CPI. Again, not happy about it. But what it really means, folks, is that disposable personal income is going up. The consumer is employed. Going into the all-important holiday season, there's going to be growth in this economy, and there's going to be growth in profits.